Warren Buffett was just 11. The year was 1942. He decided to buy stocks for the very first time. He chose City Service Preferred and bought 3 shares. Each share cost $38.25. A big step for him. He was eager for profit. His sister Doris joined in. She also bought 3 shares. They watched it closely. Soon, the price fell. It dropped to $27. Warren felt responsible. He worried for Doris. The pressure was intense, a hard feeling for him. Warren held the shares, he waited for a rise. Finally it climbed back. It reached $40 per share. He quickly sold them. He made a small profit, about $5 for his shares. He felt relief then. A surprise was coming. After he sold, the stock soared. It went up to $200. Warren missed a huge gain. He could have made more. A very painful lesson. He learned about patience and holding for the long term. This mistake was key. It shaped his future. Warren showed early business talent. Even as a child he liked money. He wanted to earn his own. He started small ventures. He sold chewing gum and also Coca-Cola bottles. He bought a 6-pack cheap, then sold each bottle higher. He learned about profit early. He was a natural entrepreneur. His paper route was important. He delivered the Washington Post. This taught consistent work and about regular income. He managed money carefully. He saved what he earned, always looking for chances. He read books on money, fascinated by numbers and how businesses truly worked. Young Warren was ambitious. He set a big goal. He wanted to be rich, a millionaire by age 30. This was a serious dream. He studied ways to grow. Investing seemed the path. He read many books found in Omaha's library. He was self-driven. His first stock test, City Service, was crucial. Quick profits were risky. Small gains missed big ones. He needed more knowledge, a solid investing philosophy. The mistake made him determined to understand markets better. He knew he must learn. This pushed his education. Warren first went to Wharton, University of Pennsylvania. He was not impressed much, felt he knew more there. Their theories seemed lacking. He wanted practical knowledge. He sought something deeper. He felt restless then. He knew more existed. His wisdom quest went on. Then a book changed him. He found The Intelligent Investor. The author, Benjamin Graham. Buffett read it many times. Graham's ideas made sense. Value, not just price. Buy stocks like businesses. A revelation for Warren. He found his real mentor. He had to learn more. Buffett learned Graham taught at Columbia Business School, located in New York City. He applied there right away to learn from the master, being Graham's student goal. He was accepted there, a big turning point. He absorbed Graham's lessons. Graham shaped his mind. Graham taught margin of safety, buy stocks for less than their true worth. He also taught Mr. Market, an emotional market partner. Mr. Market offered deals, use his mood swings well, powerful concepts for Buffett, linked to City Service, emotion should not rule. After Columbia, Buffett worked for Graham Newman Corporation. 2 years learning directly. He honed security analysis, learned to find cheap stocks, practical, hands-on work. Graham was a tough boss. Buffett valued this time. It firmed his approach, ready for his own firm. In 1956, back to Omaha. He started his own firm, Buffett Partnership Limited, with money from loved ones. He explained his strategy, follow Graham's principles, promised to be careful. Partners trusted his skill, they believed in him, start of his empire. Buffett's partnership was unique, no management fee at first. He only took profit share if returns beat 6% yearly. He took 25% above that. Aligned interests with partners. He only made money too, showed his confidence. This fairness drew investors. His good name grew fast. The partnership had great results. It beat the market always. Buffett beat Dow Jones year after year. He wrote to partners often. Letters explained his moves, emphasized long-term views, told them not to worry about short market swings. His early success was clear. Berkshire Hathaway, a new kind of company. In the early 1960s, Buffett found a company, a textile maker then. Berkshire Hathaway by name. It was struggling badly. Its stock seemed cheap. He bought shares in 1962, an undervalued asset, a typical Graham buy. He did not plan to stay. By 1965, Buffett had control. He owned enough stock. The textile business was hard, faced foreign competition. Profits were very low. Buffett tried to fix it, but the industry declined. He needed a new plan. A new vision for Berkshire. It would change totally. Buffett used Berkshire's cash, small profits from textiles, to buy other businesses. He looked for good firms, with strong economics, also bought other stocks. Berkshire slowly changed, became a holding company, owned diverse good assets. Textiles finally closed. A key part was insurance. Buffett bought insurers. National Indemnity first. Insurance had a feature, collected premiums up front, paid claims out later. This created float money, a large sum to invest. Buffett used float wisely. It fueled Berkshire's growth. The power of waiting, compounding's quiet magic. Citi's service taught patience. Selling too soon lost money. Warren Buffett remembered this. Time is an investor's friend. Good businesses grow value over many long years. Short-term noise misleads. His philosophy: buy and hold. Hold wonderful firms bought at fair, good prices. Patience lets compounding work. Compounding is powerful. Einstein called it a wonder. Earning returns on returns. Money grows much faster. Small gains add up big. Very large sums later on, like a snowball rolling. Starts small, gets bigger, gathering much more snow. Buffett mastered compounding. His long holding was key. He holds stocks for decades, lets investments mature well, not tempted by quick flips. He understands growth math. His favorite holding time, he once said, forever. This allows capital to grow for businesses and Berkshire. This long view is quite rare. Many seek fast profits now. They jump in and out, react to news daily. This often leads to loss. Buffett's way is different. Focus on business basics. Ignores markets' short moods. His success proves waiting. Compounding's magic is real. Living simply, investing wisely. Buffett's discipline. Despite billions, Buffett lives simply. Same Omaha house still. Bought in 1958 cheap. No fancy yachts for him. Drives modest cars himself. His lifestyle is frugal. This is not just an act, it reflects his true values. Substance over mere show. True in life and money. Personal frugality helps investing. He avoids costly fads. Doesn't chase popular stocks. Stays from herd mentality. Greedy others? He is fearful. Fearful others? He gets greedy. This needs great discipline. Going against the crowd. Often uncomfortable but highly profitable too. Buffett stays in his circle. Circle of competence, he says. Invests in what he gets. Studies industries hard. If he can't grasp a firm or how it makes money, he will not invest there. Missed some tech booms but avoided many busts. Discipline protects money. Emotional calm is vital. Citi's service showed this. Selling from fear hurts. Buffett learned control. Makes choices on facts and rational value study. Market panic won't sway him, nor will wild euphoria. This cool head is needed, allows for wise choices. The $38 echo how a small loss forged a giant. Let us recall that trade. Warren 11, full of hope. Citi's service preferred stock. Bought at $38.25 then. It dipped, causing worry. Sold at $40, small gain. Momentary relief felt, then watched it soar high. Up to $200 per share. A big missed chance indeed. The direct missed profit was under $500 for him, for his 3 small shares. A tiny sum to him now compared to his fortune. But the lesson? Priceless. Not about dollars lost, about principle learned. Patience is a market virtue. Short thinking costs much. That early sting of regret, it was truly formative. Shaped his core investment rules. 3 main lessons grew. First, don't fixate on quick gains. Second, don't sell good firms, not too soon anyway. Third, emotions must not rule. These rules guided his life, helped him avoid bad traps. The young Buffett was eager, perhaps a bit impatient. He wanted fast results then. Mature Buffett waits well. True wealth builds slowly, like a strong oak tree from a very small acorn. That $38 mistake, a seed, taught more than books could. Formative errors teach best. Timeless truths from a master. Buffett's journey has wisdom. His lessons are for today. Modern markets are fast. Information travels so quick. Pressure to act now. Many new investors feel it. They chase hot trends, tips, often a recipe for loss. Buffett's story helps much. A guide to old principles. Citi's service lesson holds. Patience is still critical. Resist urge for quick wins. Focus on the long term. Harder in a digital age, but more important now. Graham's value investing ideas. Margin of safety, Mr. Market. Still powerful tools now. Help navigate stormy seas. Aspiring investors learn much from Buffett's disciplined way. Live within your own means. Understand your investments. Stay in your competence circle. Control emotions, paramount. Fear and greed are poor guides. Continuous learning is key. Buffett reads hours daily, always expanding his mind. Warren Buffett's legacy is vast. Not just his immense wealth. It's the wisdom he shares. The principles he lived by. The $38 mistake, not failure. start of his real education, it shaped his patience and long-term value views. For those willing to learn, his example shows a path.